When you look at the sectors here in South Africa, mixed performance last year. Whilst we had cyclicals being underperformers, defensives like retailers were considered to have overheated. As we go into 2012, we're considered to be trading at around a 40% premium to global stocks. How does that influence the type of companies you're willing to invest in right now?
We start every year with the same sort of philosophy. Every year is basically has uncertain outcomes, and the key question often we get asked is whether this year is any more uncertain than any other years that we face. And we think that investing, the nature of investing, is all about betting on uncertainty. We don't know where GDP growth is going to go this year or next year or in 3 years' time. We don't know where interest rates are going to be. We don't know where currencies are going to be. But what we can sort of make a decent assessment on is where potential corporate cash flows are going to be, and some companies we can estimate with a little bit more precision than other companies. So 2012, as we start the year, will be pretty much as it was in 2011, and it's part of a continuum of sort of the investment process. If we look at in terms of thematically, and this is very much a sort of based on our bottom-up work. We're very much bottom-up managers. We don't take these macro calls. So we based on the opportunity set that we're finding globally, and we invest globally, we think that there's still some great opportunities in certain parts of the world, even though there's a lot of potential uncertainty that is as a backdrop. So, for instance, in Europe and the US, we think there's still great opportunities in some of the household name blue chip quality type companies. Yeah. These prices have been driven down because there's a lot of fear in Europe, and you've got companies that have got great business models, and we invest along the lines of what we call our 3Ms: moats, management, margin of safety. We're trying to find businesses with very strong moats, which is the business model, good management teams, and a large margin of safety. And it just so happens that we're finding still good opportunities in Europe and the US, and that's a theme that I think is going to continue for many years to come.
That's something that has been put into question when we're looking at investing in those countries, especially in Europe right now, with all the uncertainty. But you're clearly finding value in those markets. Yeah. And you see opportunity in companies that have been around for a long time and have that track record.
Absolutely, and I think that's a great point. And I think track records are important. If companies been around for 100 years and they don't have leverage, they don't carry a lot of financial leverage. What we did see is, during the financial crisis, some banks that have been around for 100 years went under because they had a lot of leverage in the system. So if you've got a company that's been around for 100 years, it doesn't have leverage, they must be doing something right. And we make assessment of their business and what their competitive advantages are, and whether that's going to change in the future. But if you look in the sort of the European context, when you actually drill down into some of these companies that you potentially can invest in, especially Europe and the US, you'll find that some of these companies that are actually listed in the US and listed in Europe have actually got very big businesses outside Europe. So there's a company that we own across our funds called Alstom. Alstom has if you look at the last 12 months in terms of their run rate of orders, almost 70% of their orders have actually come from emerging markets. So you've got a company that's listed in France, a European company for all intents and purposes, but is effectively an emerging market play. And we often get asked, when we look at the global environment where we're finding great opportunities, and get asked whether we find great opportunities in, say, the emerging markets, we actually often come back and say, well, we actually do have these emerging market companies, but they're listed in France.
China's considered relatively cheap right now with the 2012 PE of 8.2. I know you've just come back from China. What are your views on specifically investing in Chinese equities right now?
Just taking a step back on China, it's often, I think over the last year, potentially a lot of people have taken their eye off China because there's been a lot of negative news flow coming from Europe and the US, and that's been where a lot of investors have been focusing their attention. But it's interesting that China has been a very poor performer on the stock markets over the last 2 years. In fact, you look at the Chinese index as such has actually underperformed by almost 30% over the last 2 years, relative to the, sort of a set of global equities. But the second part as well is that China is still a big customer for many of our listed companies, Anglos and Billiton. So we took ourselves out there in a couple of weeks ago, and we reached a few conclusions, and it's very difficult to reach conclusions in China. And I think the high conviction call is that we actually don't know what is going to happen over the next couple of years. It's a very big country, it's a very opaque country. We spoke to a lot of people and we saw in a number of companies, and it's a very difficult it's a very difficult exercise to actually predict, if China is going to have a hard landing or if it's going to have a soft landing. But that being said, on some reckoning, and I've seen a number of investment banks who do this sort of cross-sectional research, suggest that China at the moment is one of the cheapest, if not the cheapest, market in these, in the global, sort of investment universe. So it's a very sort of interesting question in terms of you've got on the one side you've got investment community that's become very negative on China. In fact, we heard it at the conference from a commentator who'd been going to this conference many years, suggesting that pessimism towards China is the worst that he's ever seen. So you've got prices have come down, so all things being equal, margin of safety is starting to rise in this market, and you've got quite a large range of potential outcomes.
So if we're looking to get exposure to China right now, any specific names or sectors that stand out for you? Since we came back, we had a brief meeting, and we're just doing some more work on a couple of names. And I think over the course of the next month or two, we think we've found some great opportunities to get around some of the corporate governance issues that inevitably exist in China. Is quite a big challenge, but we think that we've found potentially opportunities in terms of getting around that, and it's something that we'll be, I guess, talking publicly and making and writing about over the next couple of months. But overall, we came back feeling that the next couple of years is going to be quite challenging in China. There's been significant overbuild. The banking sector might come under a little bit of pressure, but we still think that potentially over the long term, a lot of the pent-up demand that we've seen manifesting itself over the last 10 years is still there on the ground, and it'll take a while to clear through some of the overbuild and the oversupply. But I think over the next 20 to 30 years, I think there's still a good opportunity in this market. Which ones stand out for you?
We talk a lot about Brimstone as one company, where the basket of underlying companies within Brimstone is a fantastic basket, and these are companies that we would own in their own terms. You're getting them at a 20% discount through the Brimstone sort of holding structure. Companies like Life Healthcare, companies like Oceana. These are companies that we think have got a great future. Very strong businesses, very strong business models, and they're great compounders in the future.
Ben Bernanke recently alluded to keeping rates low for an extended period of time, a lot longer than the market had anticipated. How is that going to influence the type of investment decisions you make over the next few years?
It seems, and this is what 2011 has shown us, you've got two big forces playing on in the world. On the one side, you've got, it's almost like a scale that's tipping from one side to the other. You've got the forces of deleveraging, excess debt, and that's been very publicly. We've seen a lot of evidence about, in the developed market countries like Japan and Europe and the US. So you've got excess debt and deleveraging, which is, all things being equal, is deflationary, and it drives down, all prices across the board. On the other side of the equation, but almost the other side of the scale, you have central banks pumping money into the system, and 2012 could shape up to be a phenomenal, almost a record year if China starts easing and some of the other emerging markets actually start easing as well. You could have a year where there's significant excess credit into the system. Now, we don't know how things are going to play out, but what it does say is there's quite a large range of potential outcomes, and we wouldn't be too concerned as an investor, because these forces are going to continue to play against each other through time, but all it will do for the long-term, patient, value-driven, contrarian investor with a solid process, these forces will create opportunities for future wealth creation. When the market is fearful and that fear hits you in the gut and prices are selling off, it's a good opportunity potentially to be reevaluating equities in the long term.